We're going to record it for later. Awesome. All right. Can you see the presentation? Yes, we're good. All right. For some reason, I'm not seeing the same screen you guys are seeing, so I'm going to be looking at that one. Okay. So welcome, everybody. Welcome to the Raising Private Funds training. I am Stacy Conkey, and I am your instructor. Today, we're going to be talking about how do you raise funds for your deals. Now, we have, since we started this group, we have been focusing on passive income real estate investing, but really what our passion is multifamily investing, whether that be 2 to 4 units for people who are just getting started, or apartment buildings for people who are scaling from 2 to 4 units, or who just say, I don't really see the need to do 2 to 4 units. I want to go right into apartments. It just makes sense. Either way, we're going to focus today on raising money more for the apartment side, but I am going to talk about both because I recognize that in our group, we have a pretty diverse set of people, and sometimes people are just getting started. So I'm going to talk about it from both standpoints, but do know that when you get into apartment investing, this becomes even more relevant because you're dealing with bigger numbers. So this is a skill set that's just amazing for you to learn, and I'm excited to share this stuff with you. All right, so let's get rolling. Okay, so there's 2 types of fundraising that we're going to be talking about. The first is syndication. Actually, let me back up a little bit. It's not that we're going to be talking about 2 types. There are 2 types of fundraising. We're going to focus on one. So one is syndication, and syndication is when you bring together a group of people who are passive investors who are not going to be involved in the deal. They just put up their money and they're leaving it to you to handle it. All right. The challenge with syndication, well, for starters, one of the things that I know I was frustrated with when I was learning how to do this is syndication seems to be the thing that's out there for everywhere. Like anytime you're looking up raising private money, all the different gurus that are talking about apartments are always talking syndication. And I get it, it makes sense. The challenge is that if you're new to real estate investing or new to passive income investing, syndication it's a really big bridge to cross to go from I've never done an apartment deal to I can't do one unless I'm doing a syndication, because you're dealing with the Securities and Exchange Commission compliance. You have to get a private placement memorandum. It's a lot of cost. It's a ton of networking, and it takes so much time to put it together that what I found is that people who learn to invest in apartments, but they learn from the standpoint of syndication, they never actually do anything. Not nobody, but most people, they never do anything. And if you've been around in our group for any amount of time, you know that Jennifer and I are 100% about helping people get deals and get results, not just learn more stuff. So I'm not going to teach, other than some quick basics, just so you're familiar towards the end, I'm not going to teach you about syndication. Everybody else teaches it. And in my opinion, it just slows you down from actually getting results and getting started. And that's really what we want you to do. So we're going to be focusing on the other type of fundraising, which is joint venture. All right. So in a joint venture, you're still dealing with other people's money, but you might have 1 or 2 partners, like a small group, maybe even 3. But the big main difference between syndication and joint venture is that in a joint venture, everybody has an active role in the deal. Now, granted, you're probably going to have 95% of the active role in the deal. You're the one doing the deal. You're the one developing it. You're opening markets, researching, talking to realtors and brokers. You're doing all the lead generation. You're evaluating deals, crunching numbers, making offers. Like you're doing all the stuff. Right? You're doing the due diligence once you get it under contract. You're pulling together all the money and the financing and everything else. So you're the one doing all the stuff. But in a joint venture, your partners do need to have an active role of some kind. It could be anything from somebody's doing the accounting, or someone is doing like the minutes of the meetings. Like there just has to be some role that is assigned to them and that they do. And that role also needs to be defined within the LLC documents that are drawn up to represent the LLC that is the joint venture. Okay, so that's really the main difference, but it is a super, super critical difference, because if you don't have everyone having an active role, if you go through the Howey test, which is one of the things of syndication, you're going to find that you are required to go through SEC compliance and all of the things that represents. So you want to make sure everyone has an active role. All right. So the first thing you want to do, right? We're always beginning with the end in mind. So just like with anything else, if you think, if I'm going to go out there and look at markets and deals and talking to realtors or brokers or whatever, you have to know what it is you're looking for. Well, it's the same thing with partners. So you have to know, like, what are you even going to be talking about? So before you go out and start trying to raise funds, you need to slow down and start with what's your strategy. So if you're in the small multifamily arena, like let's say 2 to 4 units, you need to know, is it your goal to just do a straight purchase, which means you're buying something that already has tenants in there, it's already performing, you're basically putting down your down payment and having cash flow right away, right? Or are you doing the BRRRR strategy where you're buying it, renovating it, renting it, and then refinancing it, and then holding it after that, which means you're cashing out some of the initial investment, but you also have to renovate, right? So that's, it's a different strategy because one, it takes longer to get cash flow, but two, you're usually going to make more money on the equity side because you're usually buying it for low because it needs rehab. So you should be rewarded for the work that you do in the form of equity. All right. So they're the BRRRR strategy. And are you going to, end up holding it? Or are you going to do buy, renovate, rent, and sell? I also call that investor flip. All right. So depending on what your strategy is in the 2 to 4 unit, you're going to have a very different conversation with people. So if there's no way I'm doing any renovation, then there's no point in talking about doing the BRRRR strategy or investor flip because that's not going to be part of what you're doing. So the people you're talking to, you're going to be talking about, hey, we're buying properties that are already rented out. They're already performing, right away, day one, we're stepping into cash flow. And if you're doing the other strategies, you're going to talk about the benefits of those. Like, hey, we're not going to have cash flow for the first several months, but we're buying it really low. We're going to renovate. So we're going to have some nice equity in there. Then we're going to rent it out and refinance, and then we'll have cash flow, but now we'll also have equity. Okay, so it allows you to speak knowledgeably about what it is you're doing so that the person that you're talking to or the audience you're trying to attract can be clear on, oh, I'm interested in that, or, oh yeah, no, not so much. Because you might find that you're all about the BRRRR strategy, but your neighbor Bob, who's really been interested in investing for years, but hasn't done a thing about it, is like, oh, I want to invest. Oh, renovation. Yeah, no, I don't want to do any renovation, right? So you want to line up your strategy with the right type of investor or the right type of partner. All right, now let's talk about apartments. So with apartments, there's really 2 main categories. And apartments are 5 and more units. And it's funny because you have a 4 unit and you have a 5 unit. One is considered a small multi and it's considered residential as far as financing. And the other is 5 units. It's only 1 unit difference, yet it becomes commercial real estate as far as financing is concerned. And everything about it is different. It's valued different, which means the strategies are different. You make different amounts of money depending on what you do. All right, so if you're doing apartments, you're either looking at a stabilized purchase, which is like a straight purchase. So stabilized purchase is an apartment building that is occupied at least 90% typically, and it's humming. It's already performing. It's up and running. There might be some opportunity to raise the rents over time, but it's not a big play. It's not the whole play of it isn't to go raise rents. It's just to get cash flow and then try to increase the cash flow over time. The other is the value add, which happens to be our favorite strategy because it is the one that you make the most amount of money on, right? But it takes time. It takes time. It takes effort. Value add is when you're going to go in, you're going to get an apartment building that is underperforming in some way, whether it's, it needs to be renovated. It might be vacant or partially vacant. It might have tenants there that are not paying, or it could be that the units are super outdated and they're terribly under market rent, where you can go in, do a bunch of renovations, raise the rents to market, and then release the whole building. So value add can mean a lot of different things, but the gist of it is you have the opportunity to go in and through doing what we do, management turnaround, renovation, rehab, to increase the net operating income of the building. Okay, and the net operating income is, if you had no mortgage on the property, your net operating income is the same as your cash flow. All right, but it's your income minus your expenses. When you have a mortgage on the property, your cash flow is income minus expenses, net operating income minus the mortgage. All right, so value add is you have the opportunity to increase the NOI. So again, when you're looking at, next slide. When you're looking at matching the right investor to the right project, you need to be clear on what the project you're doing is. So I didn't actually see everybody who was on here. I just happened to see Brad and Marlene because of the hand raise. Like, I know from working with them, because they're in our mastermind, that they are focusing on value add projects. Like, that's what they're looking for. It's always going to be apartment buildings. And it's always going to be value add because that is the strategy that makes sense for what they're trying to accomplish in their business. So it's very clear cut right from the start when they're having a conversation with someone what the opportunity is. We're looking for projects that have upside potential through doing value add activities such as raising rents, doing renovation, doing management turnaround. And we're looking for people who are interested in partnering with us to go in and purchase the building, basically get the turnaround done. And it depends on how big the building is and what the strategy is, but it's usually 3 to 5 years. It could be as little as 18 months if it's a small building, but let's say 3 to 5 years. Within 3 to 5 years, we're going to sell the property and we're expecting to have, a significant gain because of the activities we're going to do. So we're looking for investors who want to get into a project with us for 3 to 5 years, sharing the cash flow, sharing the equity, and do a project together. So if they were unclear, if Brad and Marlene were like, well, yeah, we want to invest, but they didn't get clear on what it is they want to do, that conversation can be very awkward. And in fact, I just had the opportunity to interview Brad a couple of days ago about their whole journey. I'll try to remember to talk about that a little bit later down the line, but because they knew what their strategy was, they could explain it, and the person listening could be like, oh, yeah, okay, I'm interested in that, as opposed to, I'm just looking to invest, we're looking for people, and people don't really know, well, what does that mean? All right, so you want to know about the project type. The project type's really going to drive what kind of investor. Is it a straight purchase, or is it the BRRRR strategy if you're the 2 to 4 family, or is it a stabilized purchase versus a value add? Because in a stabilized purchase, they're going to make cash flow right away. In a value add, they might not make any cash flow right away. They might not get cash flow for the first year, but shoot, they're going to have a 6-figure gain, in year 2 or year 3. So you want to make sure that everything lines up so that everybody is excited about it and it's a right fit for their money, their time, and their risk level. Okay. The project length is also going to drive the investor. You might have someone who's like, well, I'm really only comfortable with putting money in for, no more than a year. Okay, well, you're probably not going to be doing any kind of apartment investing with that person because a year that'd be pretty quick to turn it over and get it sold or get it refinanced. So we really wouldn't plan on anything less than 18 months in a value add. So if someone is like, yeah, 6 months, maybe a year. If you're in the 2 to 4 family, then you could probably work with them on maybe the BRRRR strategy or the investor flip. But if you're looking to do straight purchase, that's a longer term game, or that's a longer term play. If you meet someone who's like, look, I don't want to be trying to put my money into stuff over and over and over. It's a lot of work for me to sit here and evaluate the deal. So I'm really looking for someone to park my money for the next 7 to 10 years. Right? So that's someone who's probably going to be a good fit for doing a stabilized purchase of an apartment building, or even for a 2 to 4 family. Okay, so you're looking to match up what you're looking to do with what's going to be a good fit for them. All right, and then the risk level. So there's different kinds of projects that are considered riskier than others. So the projects that would be considered the least risky, also the least profitable, but the least risky are straight purchase or stabilized purchase, where you're just putting your down payment, money's coming in. And yeah, you manage the property and you're managing your manager and everything else, but there's not much risk there. When you start taking on value add projects in the BRRRR strategy, well, now we're dealing with renovation. So we're dealing with contractors and we don't have a tenant in there yet. So we're doing our best to estimate what the market rents are, but there's some risk because we can't look at a lease and go, oh, it's leased for this right now. Now, the way that we do it is, we are looking to mitigate risk at every imaginable level. Like, I do not like risk, but we're in the business of making, risk assessments at every move. So there's a lot of things that we do in due diligence to really minimize the amount of risk we have. I know going in how much I'm going to get for rent, even though there's nobody in there, because there's several things we do during due diligence to find out, well, what is it going to rent for, even though I can't look at a lease right now. All right, so there's certain projects that have more risk to it. If you're taking on a vacant apartment building, let's say it's 20 units and it's completely vacant, that has a very high level of risk compared to a property that already has stuff coming in. So on a project like that, you want to work with someone who's like, cool, like, I'm all about the opportunity, let's go, let's do this, we're going to make a good profit on it. But they're not like, oh my gosh, how much money are we going to make this month? What about next month? That's not going to be a good fit for someone who you're going to take on a vacant building, right? So it's getting to know their personality, what are their goals, and matching them up with a project with you that makes sense. And if you're not doing that kind of project, it's cool. continue to develop the relationship and build the relationship with them, because down the line, your strategies might change, your strategies might expand, or like within your own network, you might have somebody else who has a project that'd be a great fit for them, and you can make an introduction. All right, so where do we find people that are going to be potential either private money lenders or private money partners? It's oftentimes it's people that you already know. So in the case of Brad, it was somebody who was in the same business that he's in, and something shifted because of COVID, and all of a sudden the investment opportunity wasn't there. And the guy was like, well, shoot, I still want to put my money to work. And it's funny because when Marlene and Brad came into our program, that was their biggest concern, is I really want to do apartments, but like our capital is already tied up. They have fix and flips going, they have another business, their capital is tied up. So how are we going to invest in apartments? And it was a really big, scary thing for them when we first started. And that was a big block. And I think we started maybe 6 or 7 weeks ago with the apartment accelerator, and just them going through it and starting to get to know it. It just opened up that door. All of a sudden that conversation became available with this person. And Brad was able to sit down and say, look, here's what we're doing. And, you know, if you want to get involved. And then that guy ended up referring another person to Brad. So all of a sudden they went from, I have no idea where we're going to any private funds, to 2 potential partners. And then one of the partners' parents. Like there's all these different things. So oftentimes it's people that you know, but if they don't know what you're doing and they don't even know what you're about or what your business is being in real estate, they wouldn't even know to ask you about it. And that was something that we had talked about. Like, you know, Brad's like, I'm private, you know, because I want to keep businesses separate. And I get it. I totally get it. But it ended up being because he was willing to do the scary thing and have the conversation with this person from this other business realm. It opened up a door, and then that guy referred the other guy. So it's oftentimes people you know. You don't have to say, oh, I'm looking to raise funds. It's not like that at all. All you're doing is saying, yeah, this is what we're doing. We're buying underperforming apartment buildings. We're doing turnarounds on them and selling them, or whatever your strategy is. Not, hey, do you want to invest with me? Because when you start talking about what you're doing, if someone's like, oh, I'm really interested in that, they're just going to ask you. They're just going to be like, well, I mean, how do I get involved in that? Where did you end up posting that? Oh, so today there was a guy, I think you posted in our group chat, but Jennifer got approached yesterday or the day before by someone that she worked with in corporate America years ago on LinkedIn, because she's been, you know, posting our real estate stuff on LinkedIn. And he reached out and he's like, hey, if you ever need any money for your deals, let me know, because, you know, he's in corporate America, makes a boatload of money, but gets taxed up the, you know what? And he's like, I mean, I'd love to get my money to work. I don't know how to do it. And I certainly don't have time to learn, but, you know, you seem to know what you're doing. So if you need any money for deals, like, hit me up. And I think she screenshotted that and sent that out in our mastermind today, just to be like, look, guys, don't forget to talk about what you do. Because she didn't reach out to him, he reached out to her, just because she was kind of out there with, hey, this is what we're doing. All right. So people you know. And then networking. Now, in-person networking is a little bit stalled at the moment, because at the time, for people watching this later, you know, this is being recorded when we're like eyeballs deep in COVID, you know, in the summer of 2020, COVID year. So we don't really have a lot of in-person networking going on, but at some point that will shift and that'll change again. And there's, you know, networking at real estate investment clubs. That's probably going to be like your highest, most target-rich environment, frankly, because when you go to a real estate investment club, if you've been to them before, you already know what to expect. But if you haven't, you're usually going to pay $20 to $30 to go. And it's usually a few hours, three hours or so of networking. They'll usually have a speaker that speaks about, you know, some topic of real estate. So everybody who's there is interested in real estate, because who's going to go pay 20 or 30 bucks and go sit for 3 hours with a bunch of people if they're not interested in the topic? So it means everybody in the room is interested in the topic. It's a target-rich environment. And here's the reality. If you're here, whether you're on this webinar with me now, or you're in our Facebook group, or you're in our mastermind, you have an interest in real estate that goes above and beyond what most people will. Like, you're here taking time on a Friday, learning something new so that you can go and implement it. Well, 99% of the population that's interested in real estate investing will only sit in that spot. Gosh, I just really want to do it. I'm really interested in that. I know that's the way to build wealth. But they'll never do anything about it. Why? Because they won't take the time like you're taking to learn how to do it. They won't make the investment of their time or their money to learn how to do it. So that is your exact avatar of who you're looking for. The person who's like, I know I want it. Like, we're not trying to convince. Jen and I never try to convince anyone, oh, real estate is the way to go. You'll never hear us say it. If you're with us right now, or you're watching this on a Facebook group, you came here because you're interested in real estate, not because we try to convince you real estate's the way, right? So you know you're interested in real estate. The people at the investor club are interested in real estate. So you're halfway there, but they don't know how to actually do it because they're not making the investment to learn how to do it. But you are, like, you're here spending your time to learn how. So you are the perfect bridge for them who are like, I know I want real estate, but I don't know how. And I have capital, but I don't know how to put it to work safely. And you might need capital, but you're actually learning how to do it, how to put it to work, and how to put it to work safely. So you are a perfect bridge for them to be able to get involved in real estate investing with you. You have a need for the capital. They have the need for all of the rest of the how-to, and you're the one to do that. So that's a very high target-rich environment. And the main thing you want to do in those kinds of things is, and I love how Kimberly is our apartment coach in our program. And one of the things she says is, look, I'm always looking to just find maybe 2 or 3 relationships out of a meeting. And I was like, I love that approach. So she will go and have 2 or 3 really meaningful conversations with people. And it's more about like getting to know them. It's not you trying to put your business card in someone else's hand, right? That the power isn't in your business card in their hand. The power is in their contact information in your hand, whether you're getting their phone number or getting their business card, so that you can follow up. So if you're talking to them and you're finding out, well, what brings you here and what have you done in real estate? Probably nothing, most likely. But some people have, but what are you interested in real estate? And just getting to know them a little bit. And then you can identify through that conversation, focusing on them first, you can identify where there might be an opportunity to then, when they ask you about what you do, which is always the way it goes, to structure your conversation in such a way that you happen to mention the things that you're doing or that you're planning on doing that would be like, oh, to them, the ones who don't know how to do it, but desperately want to do it, right? So have a deep, meaningful conversation. It's not about talking to 30 people and just getting names and numbers. It's really going deep, because especially if you identify they have a need and they have capital, and oftentimes people at investment clubs do have capital. That's why they're there, trying to figure out what to do with it or how to invest it. You're going to be the bridge for that. All right, but aside from investor clubs, there's chambers of commerce. There's, pretty much any kind of networking you do, whether it's for your current profession, if it's outside of investing, or if you're getting together on a poker night or anything like that. Just be open about what you do, all right? And then social networking. So Facebook and LinkedIn. So I'm not huge on LinkedIn. I have a profile of some stuff. Jennifer's very big on LinkedIn because she spent so much time in corporate America. Like, that was like her area, is LinkedIn. So she's super active on LinkedIn. Facebook and LinkedIn are probably the 2 biggest lead sources to develop relationships with people that you maybe have never met before in person. And it doesn't even matter. Like, we've found that there's people that we're legitimately friends with them, but we've never met them in person. And it's just through getting to know them on social media. All right. So the other thing that you can do, actually, I think I'm going to stop sharing and I'm going to show you guys something. And I did this on purpose earlier today. It's actually not a deal we're even looking at, but I posted it on my profile because I wanted to show you an example of the type of posts that you can do. But let me back up a little bit. I said when you start talking about what you do, people who are interested are going to come to you, right? They're going to be like, wait, so what are you doing? So, and you can't just go on Facebook and go, hey, I'm looking for money for this deal. That's against the SEC rules, just so that you know, like, you don't want to do that. Don't say, hey, I'm looking at this deal. I need some private lenders. I need money for the deal. Don't say that. You're going to do it in a little bit more savvy, more stealth way. So if you start looking at deals, let's say you're doing market research, you've identified a realtor, you get deal flow coming in, and you're looking at, let's say, a duplex. And if your strategy is to do the BRRRR strategy on 2 to 4 family, and someone sends you one, or you go out and find one on Redfin, what you're going to do, regardless of whether you've made an offer or not, if you've made an offer, you can say that. But if not, what you can do is save a copy of that picture of that duplex and post it on your personal profile and be like, hey, checking out this this fixer duplex in whatever market it is, in such and such market. You know, I love real estate investing or something like that. Just, you're not asking for money. You're not doing anything. You're just starting to be like, hey, this is what we're doing. Hey, this is what we're doing. So Bill and Jamie, who are in our mastermind, just mentioned that they've been starting to do that, and people are coming out of the woodwork and asking them like, well, like, what are you guys up to? All right. And then if you just, people start following your journey, especially people who want to invest and they're interested, but they have no background with it. They've never been to an investor club. They're not on any Facebook groups for investors. You're like the only one that they know is doing it, but they've heard of it and they're interested. So if you're looking at some deals in whatever market, and then you get to the point where you're making offers, every day that you make an offer, you should put a picture of the property up on there and be like, dude, just made my 3rd offer today, or something like that. Everything should always be enthusiastic. It's excited, and you're not asking for anything. And I'll even show you my post. Like, I wasn't asking for anything on this deal. I just put it up, and I had, well, at least last time I checked, I had one person who was like, hey, email me details about that. Interesting. I wasn't asking for anyone to come and approach me, but that's what happens. And now you have the opportunity to develop like a conversation with them and just have a natural thing. Like, well, what, you know, you wanted information, but like, what are you looking to do? And what kind of returns are you looking for? What kind of projects do you think you might be interested in? And then you might have to educate them about what's even possible, or the kinds of things that you're doing to see if it's a fit. But all you're doing right now is just being like, yeah, this is what I'm doing. And the people who are interested come to you. And when you're new, there's just so much pressure, and it's so scary to be the one who has to like be asking for money. It's like got this big scary stigma. And this is a way that you don't have to do it that way. All right, so let me stop sharing and reshare my Facebook real quick. Ooh, no momento. Oh, it's on a different screen. Move it on over. All right. Let me get there, and I'm going to share with you guys. Okay, there we go. All right, so earlier today when I was getting ready to put this, I was like, oh yeah, let me put one on my thing. So I just went to, I think I was on Crexy. So I would use like Redfin to look for 2 to 4 family, and just go over to the, what is it called? I'm blanking on the word, but here, let me look real quick. On Redfin, it's called filters. So the filters are on the right side. Let me flip back to where you guys can see. The filters on the right side of the screen. So if you go to Redfin and you put in whatever city, all the way over to the right at the top, and I've done videos about finding properties before, so you guys could like look through the videos in our Facebook group and you'll see these. But on Redfin, you can do filters, and you can say 2 to 4 units or multifamily, and it will cut out all the single family homes, which is the majority of what's there. All right, so I did this on Crexy, which is where the multifamilies are typically listed apartments, although they have a 2 to 4 family occasionally. And I just found this one, and it was a 60-unit townhouse project. So I just opened up the listing. I took a couple of the pictures. So there was one picture, said 60 units. Okay, so that way people who are like, oh, I kind of want to be involved in something like that, or what are you doing looking at the 60 unit? And then a picture of that, and I was like, ooh, cool. And I'll show you what I did as far as hashtagging, just to get people's attention. And then I did this picture because it kind of shows, oh, all right, this is not a performing property. And that's what I said, it was value add. And that definitely indicates it's a value add. All right, so checking out, and I didn't say I'm looking to raise money. I didn't say anything like that. All I said was checking out a 60-unit value add townhouse project in Oklahoma City. Hashtag owning the corner, hashtag value plays rule, hashtag private money, which was my roundabout way of saying, hey, yeah, we'd be open to private money on this, but I didn't ask. I didn't say anything about it. And hashtag making shit happen Fridays, because that kind of ties into the stuff that we do in our Facebook group. And it's funny. And I think part of it too is when you're looking for partners, you want to find people who, like, it's a good connection. So if someone is going to be like offended by me saying making shit happen, they're probably not going to be the most ideal partner. So I'd rather just be me and be real, because when you get into a partnership with someone, you know, it's the real deal. So I put those couple of things just to kind of be funny, but and posted that. All right, so that's the way I would do it. Well, first of all, we already had like 30 people like it or heart it or whatever, 5 comments. Oh, Marlene. Oh. But look at this. So Rafael Ramirez, actually know him. Please send info. And I wasn't even asking about it, but he was like, hey, send me some information. All right. And I think that, did you go and post this on LinkedIn too? And so Jen went, of course, and posted the same thing on LinkedIn for the same reason. I don't even know. I didn't do any analysis on this at all. It was just to show you guys an example. But if I was doing this, because we're not in acquisition mode at the moment, it's probably going to start probably in the fall, or you'll start seeing like real estate posts on our page, because we'll start looking at projects and bringing on partners for it. But we're not in acquisition mode right now, so you don't see a lot of this stuff here. But when you know you're going to be getting into acquisition mode, that's what you want to start doing. Even if you're not ready yet, who cares? Pretend like you are. Does it hurt me at all to put this thing up? No. What difference does it make? But it might attract someone who's like, oh man, I really want to get into that. Like, how do I do that? And can I work with you? And that kind of thing. All right, let me get back to our screen. All right. I have to look at Jennifer's to see like what you guys can see, because it looks so different on my side. Oh, PowerPoint. Okay. Does it look right? Yes. Okay, good. All right. So let's talk a little bit about like, what does everybody bring to the deal? And I am going to be focusing more on the 5+ units right now when I talk about this, because this is a little bit more relevant for this group, but applies to all. So when you go to finance a deal, when we're talking about raising private money, we're not talking about raising private money for the entire deal. Not that you can't. I mean, if someone is like, yeah, I have $1 million, let's go buy $1 million building. Okay, but that's not typically the way it works. Usually people are looking to leverage, as are you. So what you would typically do is you will go get a bank loan for the majority of the purchase price. Let's say 65, 70% would be bank financing. What you're looking to raise as far as private capital is the gap. It's the 30 to 35% down payment, closing costs, impounds, fees, things like that. That's what you're looking to bring as far as the money is concerned. So the first and most obvious thing that we need in a deal is capital. And if you're on this learning to raise private capital, it probably means that you have needs for capital beyond what you have. You might have some money, but not enough to do the level of deal you want to do, or you might be starting with none, and either way is fine. When we started investing in real estate, we did not have funds. We did not have any funds of our own. Everything we did was through partners and private money lenders. And it was funny because at the time I was like, man, I don't want to split a deal. But I had to really quickly get to the point where I was like, well, I don't want to split a deal. So I could make 100% of the deal, but I can't get the deal. So I can make 100% of nothing, or I can make 50% of something and get the wheels going. Because the one thing you'll find is once you get going in real estate, like it creates this momentum. Once you find a deal, the next deal comes so much easier because everyone knows that you're the real deal. You're not just talking, you're doing, right? So it comes quicker. So sometimes just getting in the game, it starts everything off going. But sometimes you're starting with some capital, right? So how you're going to structure the deal is going to depend on what you can bring to the table, what your partners can bring to the table. Now, besides capital, some of the other things that you need, and this is from a lending perspective, this is from the bank who's doing the majority of the funding, 70% or so. Someone is going to need to have credit. It doesn't mean it has to be like super stellar credit, but a lot of lenders do have a certain minimum credit score. And it's going to be different lender to lender. So if you, as the main person doing the deal, have credit blemishes or your credit score is not high, then you know that one of the things that you're looking for in a partner or partners is someone who has good credit. Because when you bring that package to the bank, they're going to want to see that the company, the joint venture, has capital, credit, right? So if you don't have it, if you do have it, then you don't really care whether your partners have it or not, because all you need is the capital, potentially. All right, another thing that the banks are looking for is net worth. So you might have a great net worth and you can carry that part of the loan, but if not, that's another thing you're looking for out of a partner. So oftentimes, and they're always different bank by bank, but oftentimes banks are looking for the borrower to have a certain amount of net worth. I know when we were doing our portfolio refinance last year, the bank had said, we want to look at your personal financial statement because what we want to see is that your net worth is at least as much as the loan for the portfolio. So they wanted to see our net worth outside of the real estate we were refinancing was at least as much as the loan. So every lender is a little bit different. So you want to find out what that is. And if you don't bring that to the table, then you know that, again, that's something that you're wanting that partner to be able to bring to the table or to supplement. All right. And then the last thing is experience. So experience really comes into play more when you're doing, like, the larger the project or the more risky the project, the more renovation or turnaround it needs, the more experience is going to be relevant. No lender cares about your experience if you're buying a duplex. Like, they're like, whatever, anybody can buy a duplex or a fourplex. But if you're buying a 45 unit apartment building and you've never done real estate in your life, they're going to be like, I mean, how do we know that you can pull this off? Like, you've never done anything. So when people have, like, kind of stair stepped their way through their real estate journey, it's easy enough to show that. But if you haven't and you're just getting into something larger, and that's a concern to the bank, you want to have partners in place who have some kind of relevant experience that's close to what you're going to be doing. But let's say that you're just doing something that's 10 or 15 units, small apartment building. Your lender might say, well, tell us about your experience. So maybe you've done a couple of duplexes or you've done a couple of single families. You're going to tell them about anything that you've done in real estate. So, and if you've done it remotely, and this is remote, you would talk about that. Hey, we've managed teams remotely across the country for X number of years. If you've done that, if you've done renovation, we've renovated X number of units. So we are accustomed to, doing the financing related to that, especially if you're doing a value add and that's the kind of lending you're looking for. We're accustomed to leading teams. We're accustomed to doing due diligence. We're accustomed to the whole thing for this so far. In addition, so that's the real estate experience. In addition, professionally, I do XYZ for my day job. And through that, I have to lead and manage X number of people or X departments, or I do project management, or so whatever it is. So sometimes you have to think outside the box. Whatever it is that you've done professionally that you could say, you know what, that actually, maybe it doesn't exactly tie to real estate, but that really has helped me become the person I am. And the person I am is the one doing the deal. And so it's your opportunity to sell yourself. So you may not have anything like that in your career, or maybe you do. If you don't, it's one of the things you want to ask your partners about. Like, tell me about what you've done for work over the years, because you might find something that they've done that you're like, oh, I could totally use that. And that becomes part of the management team that you're presenting to the lender. All right. So, like, if I was putting together something right now, I would highlight the heck out of Jen's experience. Now, she's been gone from corporate America for like 5 years now, but before that, she was in it for 22 years. And when she left her last position as an executive with Home Depot, she had 700 people that reported to her, or that she was responsible for. And she managed 1 million square foot logistics facility or supply facility. I can't remember what it's called, but
distribution center.
Distribution center. I forgot what it's called. Like, this massive building with all of these employees. And so as a leader in corporate America, she had to learn over the course of 22 years a lot about how to make things happen, how to have hard conversations, how to mentor and lead people, how to get something across the finish line. And so depending on the size of the project we're getting into, you're damn straight I'm going to be highlighting all of those things, plus all of the real estate experience. Like, anything that we can do, whether it's in or outside of real estate, that shows who we are as people, as leaders, and what we bring to the table to get the deal done and to mitigate risk from the lender. That's really what they're looking for. They're just looking to lower the risk so that they can feel comfortable making a loan on a property that you're going to be doing a project on. All right. And there's two primary structures when it comes to financing. One's debt financing and the other is going to be equity. Now, mostly what I'm talking about right now has been equity. It's like you're talking about partnering up with people. But there is another way to do it if you're talking to someone and they're like, well, that's really cool about that, we could make extra money. We sell the property, but I'm just really kind of looking for a steady. So this is someone who's more conservative with their money. I'm just looking for like a steady return that I know I'm going to get no matter what. And so someone like that would be better to be as a private lender, not a partner. So let's say you need $400,000 on a project, and it's someone like that. They're like, oh, I have the money, but I know that we could make, 12% if we do this thing, but frankly, I'd be just thrilled if I could just get 6%, but it's guaranteed. All right, so someone like that, you're going to do debt financing with. And what that means is instead of them being a partner on the deal, they're a private lender to you on the deal. And it's the same people we're talking to, and it's the same conversations. It's just you being a good listener and hearing what they're saying and what their concerns are and what their needs are, and matching up what you're offering to them with what's a good fit. So with debt financing, the different things you're looking at is what are the terms? So how long is the loan going to be for? What is the interest rate going to be? What is the amortization period? If it's going to be an amortized loan. Oftentimes when you're doing private lending like that, you do interest only. But if there's the amortization time frame of where it's just going to be paid, how long will that be? When is the note due? So it's the balloon payment. Another thing that I don't have listed on here, but is part of it, is are you going to be making monthly payments, quarterly payments, annual payments? Are they getting paid at the end of the deal? That kind of thing. And so some people are like, yeah, no, I want the monthly cash flow. I will tell you that in my experience over the past 17 years, I almost never find people who are like, I want a monthly payment. Usually they're like, just pay me at the end of the deal. I don't need to have money coming in regularly. I just want to have a return on my money. So that's always my preference. It's easier in dealing with the cash flow and things, but at a maximum, I don't really want to be doing monthly checks. I will do quarterly, but I've never actually had anybody ask for that. So if I do at some point, I'd be like, I'm not going to cut a check every month. That's a lot of work. We have a lot of projects going on. I'll cut you a check quarterly, if they want that, or preferably annually or at the end of the project, because everything we do is value add. Like it's very, very rare. I can't even think of when we've done a straight purchase. It's been years, but it's very rare that we would do a straight purchase. Almost everything we buy needs work because we like to go for the bigger dollar. We like to go for the bigger gain, the bigger jump in the equity, so that we have that in our portfolio for ourselves and our retirement. Anyway, so that's debt financing. The other things that go along with debt financing is there's a promissory note. So that is it's a promise to pay. So it's 1 or 2 pages, and it just outlines, this is how much money is being borrowed. These are the terms, and then who's the guarantor of the note. Promissory note is not considered a public document. It's a document between you and the lender. So you have it, they have it, but it's not like someone can search it on the internet. And then there's a mortgage or deed of trust, which is basically a lien on the property. So the bank is going to have first position. The bank is going to put the mortgage on the property. That's going to be a first position lien. If you have a private lender and they want to have a lien on the property, it's going to be in second position. So it's either going to be a mortgage or a deed of trust. And what's going to drive whether it's one versus the other? A mortgage is going to be in mortgage states. Deed of trust is going to be in trust deed states. And the main difference between the two is that deed of trust, it's related to the foreclosure process. So if you're in a trust deed state, the foreclosure process happens very quickly. It's not difficult to foreclose if someone falls behind. It's quick. In a mortgage state, it takes forever and a day. You have to sue the person, and it probably is going to take a year for you to be able to get the property back. So anyway, either way, I more tell you that just so that you're familiar with the terminology if it comes up. But if you're going to use debt financing with someone, you would maybe after the closing, so that the bank doesn't see that and go and freak out that you have a first and a second. But you would potentially record a second lien on the property, and that would be their security for the loan. All right, and then there's equity financing, which is a little bit more what I was talking about. So with equity financing, it's shared ownership in the deal. You own a part of the deal, I own a part of the deal. We have an LLC. The LLC owns the property, and we each own a percentage of the LLC, depending on what each of us is bringing to the table, who's going to do what. So this is something that's all worked out ahead of time. And then all that information is written into the operating agreement. And if you're doing something like this, you do want to learn, you want to use an attorney that is used to doing stuff like that. So like we use Anderson advisors because they specialize in working with real estate investors. And so they'll put together a joint venture agreement for us that outlines all the different things. And every joint venture can be different. It really depends on what are your partner's goals. So some of the different things that you can do, there's lots of different ones, but some of the 3 primary ones is there could be a different share of cash flow. So maybe if I'm putting up no money, they're putting up all the money. We might do like a 75-25 split on the cash flow. Or it might be that they don't really care about the cash flow. They don't really need it, but they desperately need the tax write-offs. Okay, so I might take a higher percentage of the cash flow and give them the tax benefits or the depreciation expense. And then the equity share can be different. So everything can be 50-50, but it doesn't have to be 50-50. Like, what if you're bringing some money into the game? Like, maybe you're bringing up half the money, they're bringing half the money, but you're doing like 95% of the work. Well, it doesn't make sense for you to split the deal 50-50 at that point, because you're bringing more than 50% of the value of the deal to the table. All right. So all these different things are negotiable between you and the person. You just got to know, like, what do they need? Because then that allows you to structure the deal in a way that works for them. Obviously, it has to work for you as well. All right. And then there's a debt equity blend. Now this is where things get a lot more advanced, but there's something called a preferred return and a waterfall. So the preferred return is when, let's say you're talking with an investor and they're going to be a partner in the deal, but they're a little bit more conservative and they're like, well, I don't want to do this unless I know for a fact that I'm always going to get at least 5% or 6%, whatever their number is, cash on cash return after month X, whatever it is. So as long as you can guarantee me that, I'll do the deal. So the way that works with the preferred return is the first person that gets paid out or gets calculated is any investors that have the preferred return. So from the standpoint of the person doing the deal, it's not ideal to have someone in there with a preferred return, but sometimes if you're dealing with someone who's more savvy, it's necessary to get the deal done. All right, so all that means is the preferred return people get paid first, and then based on what's left, the rest of the operating agreement goes into play as far as what the splits are. All right, and then a waterfall, that's a little bit more towards syndication, but I want to at least familiarize you with some of the terminology, because it could come up in a conversation with someone, and I don't want you to be like I don't even know what they're talking about. A waterfall is when, let's say that I'm a developer, I'm doing a value add project, and I have my investor partner, and the investor partner says, okay, so I'm fine with this split, but if you do as good as you say you can do, then I'm good with you taking even more of it. So with a waterfall, you come up with these different scenarios. So once the first scenario is hit, like let's say it's, once the property has hit 8% cash on cash return, then it goes to the next tier. And with that waterfall, maybe it was an 80-20 split, and now it's a 70-30 split. And when you hit that tier, whatever that was, maybe it's return on investment, maybe it's cash on cash return, whatever it is, now it becomes a 60-40 split. So as the developer of the deal, you're rewarded with more profit, more cash flow, more whatever, more benefit, the better you are at executing the deal. But it gives the investor partner the opportunity to say, well, I mean, if this deal isn't as good as you're presenting, then this is only going to be an 80-20 split. You're only getting 20%. But if you kick butt on this and you hit these different goals that you say you can hit, I'm fine with you getting paid at different levels. So that's what a waterfall is. And maybe at some point I'll do a training on that. It's so advanced, and they've even developed like a whole waterfall model, but it kind of makes your brain explode a little bit. So I might do that for like an advanced training day, but it is something out there, and it is something that you'll hear about when you're talking to people who've been in the business for a long time. All right, and then the last thing we're going to talk about, and it's just for the purpose of knowing what it is. I don't really want you focusing on it now, because I just want you to get started, right? So it's syndication, and you're going to hear it all the time because it's the way that everyone says you should finance deals. Yeah, especially if you just want to sit in learning mode all the time for the rest of your life until you die, right? So we're not in that mode. But syndication, like I mentioned, you're subject to the SEC rules and regulations. You have to do a PPM, which is short for a private placement memorandum, and those can cost anywhere from $10,000 to $20,000 on average. So there's a lot more cost involved when you're doing this. So it's like, you better be serious. You have to know the difference. You have to get a lot of education around this, which we have done. You have to know the difference between the accredited investor and a sophisticated investor, and then a non-accredited or sophisticated investor. Because depending on what kind of deal you're doing, which regulation you're doing, is it a 506B, is it a Reg A? They have all these different things. You're only allowed to have a certain number of sophisticated investors, or you're only allowed to advertise to accredited investors. Like, there's all these really, really specific rules, and it really narrows the field for the people that you can work with. And it gets you to the point where you have to ask a lot of detailed questions about them to know whether you're even allowed to pitch the deal. Okay, so that's just know that that's some of the common terminology out there. With syndication, you have to establish that you have a pre-existing relationship. What that means is, let's say you're talking, that's why I said you can't post on Facebook, hey, I'm looking for money for this deal. In order for you to pitch a deal to someone, you have to have a pre-existing relationship with them. All right. So you'd have to establish like, hey, I met them this time. We had this phone call. We had this email. So you got to be really good at documenting all the times you're having conversations. When you get to the point where you're going to do syndication, which you probably all will at some point in the future, especially when you get into bigger and bigger deals, when you get to that point, your documentation has to be on point. Because if the SEC ever comes back and says, we don't know that you did this legally, you have to be able to say, I absolutely did. Here's how many times we had conversations before I ever pitched the deal to them. So, and you would have like a questionnaire that asks specific questions that you could prove that they're accredited or prove that they're sophisticated and show that you went through all those things. The whole point of it, it's not that the SEC is trying to be a pain. I mean, maybe they are. I don't think that they're trying to. What they're trying to do is they're trying to protect people who don't know how to evaluate a deal from being swindled. That's what, so if someone's an accredited investor, they make a certain amount of money per year. I can't remember what it is. It's 200,000 or 250, and it changes, but it's like, it's a significant amount of annual income. And they have to have a certain amount of capital. I want to say it's like $1 million. So there's certain things that would make that person more likely to know how to evaluate a deal, because otherwise, how would they have this much money? How would they be this far in life financially if they didn't? So that's what the SEC is trying to do. They're trying to make sure that when someone's getting into a deal, they know what they're getting into and they know how to evaluate it. So anyway, it's something you can do. I just say save it for later, for when you're further along and you've got some deals under your belt. Plus, then you can use all those deals you've done as just showing people that you know what you're doing and that you're proven, you have credibility. All right. So I know that a lot of people who are here are already in our mastermind. You guys are amazing and we're super excited. Just keep rocking it. If you are not in our mastermind or in our Facebook group, well, if you're not in our Facebook group, you got to come over and get into our Facebook group so we can start, training you and teaching you. We have a lot of free resources there. If you're in our Facebook group, but you're not in the mastermind yet, and you're like, I want to do it. I feel like I just need help to get started. I've been trying to, and I just haven't gotten anywhere. That's what we're here for. Or if you've been doing real estate, you're looking to scale your real estate to the next level, get into apartments or get into portfolios, and you just know you don't want to do it on your own. You don't want to, take a chance of making a mistake and losing $40,000 on your first deal. Like, we've done stuff like that, right? It sucks. It's no good. And you want help. You want mentorship. You want to be part of our mastermind. Just reach out to us. You can text. That's our business text number. You can just text the word freedom to our business line, and that's 619-373-8461. And it'll just shoot you an application for our mastermind, and you can fill out the questionnaire, and then we'll reach out to you and schedule a call and see if it's a good fit. So anyway, so that's available to you guys if you want some help. You're not already in our mastermind. And what I'm going to do now is give me a moment. I'm going to stop sharing, and I'm going to bring, wow, we have 24 people on our attendees list. I'm going to bring everybody over, but here's the rule. Here's the rule. I'm going to bring everybody over into here so I can see all of you, but I want everybody to turn your camera on, because there's nothing worse than sitting here talking to a whole page of just names. It's just weird and uncomfortable. All right, so I'm going to bring you guys all over. So give me a minute to promote you to panelists. Please turn your camera on so I can see your fabulous, beautiful selves. And then I'm going to do open Q&A. If you just want to sit and listen, that's cool. Still turn your camera on for me, please. But if you have questions, that's what we're here to do. All right. Working on it, working on it, working on it. Promotions happening everywhere. Promoting the panelists. Oh, Tori, you're here. Thalia, yay. Lupe. Oh, see all sorts of people in our mastermind here. I love that. You guys are amazing. Joni. All right, here we go. Almost done. Allie and Michael. Sometimes I can't see your guys' names because they put like a little thing over it. There we go. Okay. Everyone has been promoted. Congratulations on your promotions. Okay. All right, and I think the earlier chats were when we hadn't started yet. Okay, very good. Well, welcome everybody. If you have a question, do me a favor and hop over to the chat and just say, I have a question, so that I can like call on you and you can unmute and we can have a conversation. Or if you raise your hand, I might just not see you because there's a whole bunch of people on the screen. No questions? Everyone wants to just listen to everyone else's questions? Should we make up some questions? Are you on Facebook? Does anyone on Facebook have questions?
Actually, Michael Fallon had a question about how to get in front of other people all the way from Australia.
Oh, okay. So, is that Awesome Michael? Is Awesome Michael Fallon? All right. Well, I just saw Jennifer just said we had a question from Michael Fallon, who is in Australia. He's always on our stuff, and it cracks us up because it's like 5 p.m. on Wednesday, and he's like, it's 10 a.m. on Thursday morning here. Anyway,
he literally just said, I'm still in bed. It's Saturday.
Oh, it's Saturday. Oh, he's still in bed. It's Saturday. I love it. Oh my God, it's amazing. So Michael asked the question, like, I'm in Australia. How do I get in front of people? I mean, the reality is I don't even know where everybody here is from, but I know, like, Kahisha, you're in North Carolina, right? And Joni, you're in Orange County. Ellie, Michael, well, you're here in San Diego, as are we. Marley and Brad, you guys are in Colorado, right? We're all from all over the place. So what I'd say to you, Michael, is what difference does it make? How do you get in front of people? Social media, sir. So you being in Australia, there's a couple things you could do, actually. This actually applies no matter where you are. When you're talking to people around you, you're just still talking about what you're doing. Michael, for you, the only thing that you're saying different than what everyone else would be saying who's not from outside the US is you would just be saying, I'm investing in the US. I'm investing in cash flow properties. I'm investing in this, I'm investing in that in the US. And then you're just selling that. And people are like, oh, it's so far away. Oh yeah, well, I run teams, I lead teams. Everything is done remotely. And that's the case for all of us, right? Jen and I live in San Diego. We don't invest in San Diego. The numbers here are insane. There's no positive cash flow here. Look at Allie and Mike, big eyes. Numbers here are insane. There's no cash flow here. We manage projects remotely. We don't fly to different markets to do deals. We do it from here. And Michael will be the same thing. You just tell them, look, I'm doing it. But the bigger opportunity for you, frankly, is probably going to be social media. And social media in groups that are, I think they have to be in the US. It just, like I know in our group, probably 95% of people are in the US, but not everybody. It's going to be a little bit of an easier sell to someone who is going to be located in the US because you don't have to, they're not like, what do you mean in the US? Because they would just assume that, you know, it's local, at least in their continent, in their country here. So that's what I'd say, Michael, is just connecting with people on Facebook, going into Facebook groups that are like ours, ones that are like landlords, or any groups that are related to the kind of real estate you're specifically doing. And just start commenting when people ask questions or they make a statement, and especially if someone did something good, like be like, that's so awesome, congratulations. Work on building, you know, building relationships through commenting and answering questions or asking questions, and then go connect with them off of Facebook through Messenger. And that's just how it gets started. And then get on the phone and do a Zoom call. Our physical look, I mean, if one thing COVID has taught us, our physical location is just not relevant to anything. What we found is like a lot of businesses can be done wherever your computer is. That's been the case for us forever. We've always done remote investing. And now with everything shifting and people not being able to go to their office, if that's the case, they're realizing I don't have to go to an office. Well, same thing. I can have a conversation with you, Michael. You might be in Australia. I'm here in San Diego. What difference does it make? We're on Zoom and we can have a conversation. And if you have money and I have a deal and we want to do it together, cool. So I don't think that you need to have, how do I do this from Australia, as really a thing, because what we teach at the very core is remote investing.
Laurel has a question.
All right, Laurel, what's your question? How can I help you? Go ahead and unmute.
The question is, what are some of the keywords that you look for when you're looking for Facebook groups and stuff, to be able to connect with people?
Say that one more time because it broke up. So what are the key words when what? You might have to type your question because I think it's.
Brad has a question in the meantime.
Okay. Yeah, go ahead and type your question, Laurel, because for some reason we got a bad internet connection. All right, Brad. This is the famous Brad I was talking about earlier in the call.
Hey, we do it. It's Friday. It's been a long week. Question, when you said there, sometimes the lenders will look for your personal net wealth or whatever you want to call
Net
it.
worth, yeah.
Yes, same thing. Sorry.
No, you're right. You're okay.
If your net worth isn't as much as you're asking for in a loan, are you going to be turned down, or are they just going to charge you more points, or how's that work?
It could go either way. All lenders are different. I was just giving the example of the lender that we happen to be working with. They had said, we want to see that your net worth is at least as much as loan we're giving. It's not always going to be the case. It might be some percentage of it. But my main point is whatever the requirements are, if you're not bringing that to the table, it's part of what you're looking for in a partner is someone who maybe between yours and theirs, it meets the lender's needs. But if you know that you don't have like a high net worth, you're going to want to look for a partner who has not just the capital to bring, but also has a net worth, has a balance sheet that they can be like, okay, yeah, our business, the partners in the business have this amount of net worth. And yes, it's also possible, Brad, that instead of them just saying no, we haven't been in that situation. We've never had a yes or a no situation, so it's hard for me to say for sure. But based on just knowing how lending works in general, if there's a higher risk, which if you don't have the net worth they want, that'd be considered a higher risk. They're not necessarily going to say no. They might just it's probably not higher points. It's usually higher interest. If the deal is considered riskier, or if it has like a lower debt service coverage ratio, also something that would make it more risky. It's not that there's more points, but the interest rate is higher. So whether they're going to say yes or no, every lender's different. Some of them are a lot more conservative than others. And the ones that are really conservative, they might be like hard no. And other ones are like, well, I don't want to say no, but we need to have something to compensate us for, the borrower not meeting our exact criteria.
And does that make a difference if it's a house, apartments, multifamily, duplex?
When you say, are you talking about from the lender standpoint, or are you talking about what drives the net worth?
The net worth, yes, correct.
No, it's everything. So like when we were doing our loan, when we did our personal financial statement, we listed all of our assets, personal and business, because all our assets, most of our assets are owned by LLCs, other than like our personal property, vehicles and stuff like that. Everything's owned by LLCs. But what they're looking for is, they're not looking for the semantics of who owns what. They're just saying, okay, tell us what you have. And for the lender, I'm not saying, oh, this company owns this house, this company owns this apartment building, I just list all the assets and then list all of the mortgages. And when I list the assets, this is more of a strategy. When I list the assets, I list the market value. So for example, when you guys are flipping a property, at the moment that you're flipping the property, right, you can have the ARV be whatever you say it is, until you sell it, it's whatever you say it is. All right. And then what you owe on it is just whatever liens are recorded against it. So for example, you might have a couple of flips where you have a partner in on the deal. I'm not listing all of those details. I'm just saying, hey, here's this property. This is how much it's worth. This is how much we owe, because they wouldn't see it on a credit report, but if they could see it, or they could see it recorded somewhere, I'll put that. So that will help your net worth to be expanded, because you're listing any assets you have. And they're not usually going to go back to check the value. So for your other business, you might say, oh, our assets in our other business are worth this amount of money, and this is how much we owe on them, if anything. I don't know if you guys finance that or do it cash. So there's a little bit of flexibility in how you present your net worth, but it's everything. It's everything you own, even personal property. You can say jewelry, art. Jennifer's done some great paintings. I think they're worth a lot. I didn't really list them, but I'm not saying that it wouldn't though.
Sounds good.
Yeah, and when you guys get to the point where you're applying for a loan, because I know you're, starting to the point you're making offers, when you're looking to apply for a loan, that's part of what like Kimberly and I will help you do is how do you present best to a lender to have the best shot of getting a yes. And if you know that you're really far off from it based on the size of the deal, then we know what we're looking for from the partners, and we know what we're going to ask them for, and how to coach them into a financial statement that is going to be good to go along with ours to give to the lender.
Awesome. Sounds good. Thank you.
Right on. All right, Laurel. Okay, so Laurel, my question is, what are some of the keywords you use to search groups on Facebook or Google? Okay, well, it would pretty much be Facebook or LinkedIn, but Laurel, it depends on what you're looking to do. So if you're going to do cash flow, actually, well, knowing that you're a mastermind, you're looking to do cash flow properties, you would look for groups that would have people who would be interested in cash flow. So you might search cash flow, you might search landlords, you might search passive income, you might search apartments, anything that would likely be attracting a pool of people who are interested in that type of investing. And if we were having a conversation that you were raising money for fix and flips, I'd say go look for fix and flip groups. You know, does that make sense? Did that answer your question?
How are you finding your deals during COVID?
How are you finding our deals during COVID? The same way we find our deals any other time of the year. So the one thing that we do that is different than some of the other people out there who teach is first of all, we live in San Diego, as I mentioned. We don't invest here. So all of the in-person strategies of door knocking and bandit signs and all those other things, we don't do. We've never done. I learned them when I was a new investor 17 years ago. But frankly, every time I've lived in a place, it didn't make sense to invest there based on what I was trying to accomplish. So I've always done remote investing. So for us, everything is about leveraging, and it's leveraging relationships with realtors, brokers, and wholesalers. Every once in a while, we've done a for sale by owner, but usually I think I'm dealing with a wholesaler, and I just find out it was someone who listed their own property on Craigslist. But we are always leveraging other people's time and work. We don't mail letters, we don't do door knocking, we don't cold call, we don't do skip tracing, we don't do any of that. First of all, everybody and their mother's doing it, and so it's not even effective anymore, even though it's taught as like the main thing. And so what we found is, and people will say, oh, there's no deals in the MLS. Bullshit. That is a flat out lie. Yes, there are. Yes, there are. Sorry. Marlene's like, that's not true. It's not true. There are deals everywhere. What it comes down to, like, I'll give you an example of this. Like, okay, Battel's not here today, but Battel in our mastermind, she's a 9-unit property under contract in Florida, and it's a motel, and we're just turning it into Hotel Battel. But what it is she's operating it like an Airbnb with like 9 different Airbnb units. Now that property has been on the market for, I don't know, 6 or 9 months, like a long time, on the market, listed. And it's been under contract 4 or 5 times. And now she has it under contract, and she's, almost through her due diligence. The deal she ended up getting on that is infinitely better than people before. And let me explain why. I just had somebody new come in. And let me explain why. She was just there last week when she went to go do her due diligence. She wanted to go be there in person, walk through, be part of the inspection. So she went. Well, while she was there, she ended up meeting another broker. And the other broker was showing her around. He had another building that he owned. So he was just driving her around, relationship building. It's not even her broker, but he wants her business in the future. So they're driving around, and he's like, so what did you end up getting that deal for? And she told him, and he's like, are you kidding me right now? If I knew that he would have taken that, I would have bought it. She's like, But she went in and she negotiated to get to that point. But here's the thing. It was listed, but all those other people couldn't get the seller to go lower than $500,000 down. It was a seller finance deal. And Battel happened to come across, and she's like, I cannot put more than $300,000 down because it needs $200,000 of work. All right, so I cannot give you $500,000, but I'm very interested. And basically just kept him, and he was motivated enough after 9 months of it being and going in and out of contract. And he was 70 plus years old, and he's managing himself. He's tired. He's physically tired. So if she had the belief and operated from a place of, oh, well, there's no good deals that are listed, which is absolutely not true, we don't know what the deal is. All you can do is make the offer that makes sense for you. It's up to the seller. And where's the seller? Is the seller motivated enough to accept an offer that is lower than what they originally wanted? And if Patel never made the offer just because she had heard, oh, there's no good deals, or, oh, he won't take less than 500,000, she's just like, I'm not listening to any of that. This is the offer that works for me. And it opened up a dialogue back and forth, back and forth. It took a couple weeks for them to negotiate, but she got the property for $125,000 less than what he was asking, and $200,000 less of a down payment, because it had been long enough that he was like, you know what, I'm done with this. I just got to move this property, and here's a buyer, and she's serious, and it's not exactly what I wanted, but like I'm tired. And COVID hit, so he's probably hurting financially because he has a whole bunch of these motels, and travel is down. So anyway, so to answer your question, we use realtors, brokers, wholesalers, sometimes for sell by owner, but don't operate under the assumption or the belief that if you can't go directly to seller and get like a desperate seller, that you can't find a good deal, because it's just not true. There's no truth to it. You can absolutely work with realtors. Realtors all the time bring us off-market deals. But it's the realtor. I originally found them from a listing, built a relationship. They know who we are. They know that we're serious. They know that we close. And so we oftentimes get deals brought to us that we wouldn't have known otherwise because they weren't listed. But it started with one that was listed, right? And Natasha, she's our strategist in our organization, but she's in our mastermind as an investor. She came across one deal that was listed, MLS listed, built a relationship with the realtor. The realtor says, well, I mean, this same seller has 5 other properties also. Are you interested? She never would have known about those 5 had she not gone for the one that was listed, right? So that's just, I know that's kind of like a long way of answering that, but I just want your mindset to be open that you can absolutely do real estate leveraging the work of realtors and brokers, because it's the relationship and all the contacts they have that you're really stepping into. And sometimes the properties will be listed, and sometimes it'll just be the connection that you made from a listed property that brings you a deal. All right, any other questions? No? All right. Well, I hope, was this helpful to you guys? Yeah? Right on. Very good. All right, well, good deal. Well, all of you have an amazing weekend. Again, if you want to get into the mastermind, you're interested and you're not already in it, I know most of you guys are already here and I'm super excited, text that number that I put up earlier, and we look forward to being a part of your journey. And have an awesome weekend, guys.